Hello everyone. In this video, I will be discussing few more issues about the weighted average cost of capital, and we will see a few examples. So, first of all, when we include debt in our capital structure, what and how we should be including it. So, we will be discussing these 5 points essentially. How does the formula change when there are more than two sources of financing? What about short-term debt? What about other current liabilities? What are the cost of how are the cost of financing calculated, and company versus industry weighted average cost of capital? First of all, how does the formula change when there are more than two sources of financing? You remember so far we had two components. One is the cost of equity, another is the cost of debt. Okay, so and these two contributed to the calculation of weighted average cost of capital. So just to remind you again, this is the cost of equity, this is the proportion of equity in the total capital, this is the cost of debt and proportion of debt in the total capital, and this is the 1 minus tax rate, since we get a tax advantage on the interest. Now we have additional component, that is preferred stock. Okay, so since we are including common stock, preferred stock, and debt, so all these three components will contribute to the calculating weighted average cost of capital. So you can see that we are calculating in the similar way. This is the cost of preferred stock. The cost of preferred stock is essentially the dividend paid to the preferred stockholders, and then proportion of preferred stock in the total capital. So this is cost of common stock, this is cost of preferred stock, and this is cost of debt, and these three jointly contributes to the weighted average cost of capital. So this is how the formula changes when we have an additional component in calculating the weighted average cost of capital. So the second point we discuss is, what about short-term debt? You know that many companies consider only long-term financing when calculating weighted average cost of capital. They leave out the cost of short-term debt. In principle, this is incorrect. The lenders who hold short-term debt are investors who can claim their share of operating earning as well. The company that ignores this claim will misstate the required rate of return on capital investment. Okay, that's why if there are short-term debt, that also should be included in calculating weighted average cost of capital. So if I go back here, you can see this part is our cost of debt. Now if we have two components, for example long-term debt and short-term debt, we will have these components will be broken into two parts. So one will be for the short-term debt, another will be for the long-term debt, and in that case there will be four components in calculating weighted average cost of capital. Then what about other current liabilities? That means other than short-term debt, if there are other current liabilities, what happens? Current liabilities are usually netted out by subtracting them from current assets. The difference is entered in the net working capital on the left-hand side of the balance sheet. So since other current liabilities are already netted out, so we may not include them in calculating weighted average cost of capital. Then how are the cost of financing calculated? You know that you can often use the stock market data to get the return on equity and expected rate of return demanded by the investor in the company's stock. So you can remember about capital asset pricing model. So using capital asset pricing model, we can calculate the cost of equity. Weighted average cost of capital is not too hard to calculate, because the borrowing rate, the cost of debt can be easily found, because that's the rate at which the company lend money to, the company borrow money from its lenders. And once you have cost of equity and cost of debt, you can easily find out the proportion of debt and proportion of equity, and you can calculate the weighted average cost of capital. And last of all is the company versus industry weighted average cost of capital. Sometimes you want to know what your company's weighted average cost of capital is, yet industry weighted average cost of capital is sometimes useful, so that you can compare that whether your company is raising fund at a higher or lower than the industry averages. So we have discussed these points already. Just to get back to our point, that adjusted present value versus adjusted discount rate. So we initially discussed that we calculated net present value for the project so far without considering the effect of financing. Now, as far as the financing is considered, we can incorporate it in capital budgeting in two ways, either by adjusting the discount rate or by adjusting the present value. Okay, so the question is how we do that. So adjusting discount rate, we already know how we adjust the tax advantage, and adjusting the present value, as we have seen, that we calculate the base case NPV and we see the present value of the impact, that is the adjusted present value. So just an example look, this is our base case NPV. For example, this is our initial investment, then operating cash flow, and divided by the weighted average cost of capital. So this is our base case NPV, and this is the present value of tax shield, which is 1.067. So the adjusted present value is, you can see that this is our base case NPV, which is 1.067, and this is basically a negative. Okay, this base case NPV is negative. So since our base case NPV is negative, and this is the present value of tax shield, which is so adjusted present value is 0. However, you can see that in this case, the base case NPV, we discounted the cash flow by the weighted average cost of capital, and we also discounted the tax shield by the weighted average cost of capital. However, we previously argued that this tax shield can be less risky because the firm has a regular stream of this tax shield due to its debt. That's why we may discount these cash flows by a lower rate. For example, in this case, as we discount this cash flow by a lower rate of 6%, we have present value of tax shield is 1.75, and you can see that now our adjusted present value is positive. Okay, so previously our adjusted present value was 0 because the tax shield was discounted at a higher rate, but as we change the discount rate, we have a positive adjusted present value. So this is another example. Project A has an NPV of the 150,000. In order to finance the project, we must issue a stock with a brokerage cost of 200,000. So project NPV is 150,000 and a stock issue cost is 200,000. So you can see that adjusted NPV is negative. So although the NPV of the project is positive without considering financing effect, as we consider financing effect, the adjusted present value becomes negative, so project becomes unacceptable. On the other hand, you can see here that the project has a negative NPV of 20,000. We can issue debt of 8%, and the present value of tax shield is 60,000. So you can see that project's NPV is negative 20,000 and present value of tax shield is 60,000. This is not a stock issue cost. This is the present value of tax shield, so adjusted present value is 40,000 positive. So what I am trying to say here, that sometimes a project's NPV can be positive, so apparently we should accept the project. However, as we incorporate financing side effect, the adjusted present value may become negative, so project may become unacceptable. On the other hand, sometimes a project NPV can be negative, so apparently we should reject the project. However, as we incorporate financing side effect, for example, the present value of tax shield, adjusted present value becomes positive, so project becomes acceptable. So that's the end of our discussion on this chapter. Thank you very much.